Okay, well, hi everyone. This is Professor Sam Alonzafami again. We're going to continue our discussion on plant assets. Last time I showed you how to calculate depreciation under straight line, units of production, double declining balance. We talked about depletion, we talked about amortization, but our main focus was showing you how to do depreciation under a full year scenario and a partial year scenario. This time, we're going to talk about what happens when you decide to get rid of these plant assets, more probably before their time has expired. So there's a couple of ways you can do that. One is by selling them. Another one is trading them in. I guess you can dispose of them also because maybe they're lost in a fire or they got destroyed or they're just not working anymore. But we'll focus our attention on the sale of plant assets and the exchange of plant assets. And the plant assets in this exchange discussion will be of assets of like purpose. In other words, you trade in a machine for a similar machine. Okay, not a machine for a car kind of thing. Okay. So let's talk about the sale of plant assets. A couple of rules that we need to be aware of. And number one is that gains and losses are recognized, which means you will actually journalize something called gain on sale and loss on sale. So recognize basically means journalize. Okay? When it comes to exchanges of plant assets of like purpose, only losses are recognized, and only if they are material in nature. In other words, they're a major amount. So only losses are recognized and only if they are material. Okay? So you don't recognize gains. So let's just write that down. Gains are never recognized. Okay, so a couple little rules to live by. So let's jump right into an example here. Let's say I have a cost of an asset, and let's say it's we'll go how about $80,000, and let's say we have depreciated this asset for a few years. Who knows? Maybe we use straight line. Maybe we use some of the years digits. Well, actually, we could have, but I never showed you that one in the previous one. But units of production, double declining balance, whatever technique you used, let's just assume that the amount of depreciation we have taken so far is $60,000. So if you remember the definition of book value is when you take your accumulated depreciation and you subtract it from your cost. This is what we get when we say book value. You may have heard of the Kelley Blue Book. Well, that's basically all based on depreciation techniques. Kelley is just a company that calculates book values, and they're called the Kelley Blue Book. So in this particular example, we're going to pretend that our cost of this asset initially was 80 grand. It's been depreciated thus far. Let's just make it simple. It's been depreciated 6 years so far at 10,000 a year, okay? And that gives us a book value of 20,000. I'm going to call this old just because this is the stuff we're going to get rid of. And we're going to look at three scenarios, okay? Scenario A, what if we sell assets for $20,000? B, what if we sell the asset for, let's go, $5,000? And scenario C, what if we sell the asset for, let's go, $30,000? Okay, so those are the three scenarios we're going to analyze. So what we're going to end up doing is first calculating whether or not we have a gain or a loss, or neither, and then we'll do the journal entry. So when trying to determine if you have a gain or a loss, what you have to do is you got to compare your book value to what you're getting for it. So like in scenario A, there is no gain, no loss. Okay, so in other words, we broke even. In scenario B, our asset is worth 20 and we're only selling it for 5. So we have a loss of $15,000. Took a big hit on that one. And scenario C, our asset is worth 20, but we're selling it for 30. So that gives us a gain of $10,000. So as you can see, 3 different scenarios. So let's take a look at the journal entries that are associated with this. So what might be helpful is maybe before I even do the journal entries, let me make some T accounts here, okay? And these T accounts are pretty much going to be standard no matter what the scenario is that I throw at you. The common denominator or denominators are going to be these T accounts. And basically, these T accounts are, do that. Make this the debit side, and we'll make this the credit side. So basically, these T accounts are a visual representation of the data. So this data that I'm going to put here in yellow, these T accounts are in essence the same thing. Okay, so I'm just going to copy this and put it here as well. And this one we are going to label we'll call it equipment. And this one we will label accumulated depreciation. And that is for the equipment. Okay, so I'm going to enter in this $80,000 on the debit side of the equipment, and for the accumulated depreciation, I'm going to put that on the credit side. Remember, accumulated depreciation is a contra asset. Right? You've known about that since the first time you learned about adjusting entries, and we just recently discussed that in the previous video. So as you can see here, this equipment account has an $80,000 original balance, and the accumulated depreciation is up to 60. So now let's go through and do the journal entries. Now keep in mind, we're selling our assets, so that means the equipment has to go away, and so does the accumulated depreciation because we don't have it anymore. We're selling it. Okay? So the journal entry would be as follows. You're going to debit cash because we are collecting $20,000 in scenario A. The accumulated depreciation has to come off the books because we no longer have this equipment. I can't get rid of the equipment and still have the accumulated on the books. It doesn't make any sense. If I get rid of the asset, I can't still have the contra asset. It's going to contra nothing. So the accumulated depreciation must be removed from the books as well. So we'll do that. We'll debit the accumulated depreciation. Okay, so we got 2 debits so far, and then we want to get rid of the actual equipment itself. Okay. So how much cash are we getting for this equipment? We're getting $20,000. The accumulated depreciation has to come off the books at the value that it was on the books. So I'm just going to copy that 60. And then the equipment has to go away. It's like doing a closing entry almost. You're basically doing the opposite of what's there. Okay, and that is the answer to scenario A. Let's now go ahead and do scenario B. I'm just going to copy these down each time so that they're in our eyesight. Fill in those amounts one more time. There we go. Okay, so now scenario B. In scenario B, if you recall, we have a loss of 15,000. Why do we have a loss? Our asset was worth 20 and we only sold it for 5. So we have a loss of $15,000. So basically, the entry is going to be very similar to what we just did in the previous entry. The only difference is we're going to show a loss. And you want to treat losses like expenses, and we always debit expenses. So we're just going to call it loss on sale, and then we're going to credit the equipment account. So the equipment, again 80, the accumulated depreciation, again 60. So I'm putting those two in that we know for sure from the T accounts. How much cash are we getting? We're getting $5,000. So we'll put $5,000 in that spot. So if you just take a look at our debits and our debits so far add up to 65 and our credits add up to 80. This can't be done because we're not in balance. So we need another number here to make this thing balance, and that needs to be $15,000. Now our debits equal our credits, and take a look, 15,000 we said, and over here 15,000 we said as well. Okay, so now let's go ahead and do the final scenario. If we do that, we'll put that in here. And again, let me copy these amounts. Okay, so let's go ahead and do scenario C. Scenario C, we sold the asset, but this time we sold it for 30. And if you remember, if our asset's worth 20 and we sold it for 30, we have a gain of $10,000. So let's see how this journal entry looks. So scenario C, we're going to debit cash. And how much are we going to debit it for? Well, what do we get for it? We got 30,000. So we're going to debit it for $30,000. Remember, the accumulated depreciation has to come off the books. So no matter what the scenario is, the depreciation account has to come off the books and the asset has to come off the books. So the accumulated depreciation has to come off at 60. So does the equipment. And the equipment has to come off at its cost of $80,000. So now if you look at it, our journal entry has 90,000 on the debit side, 80,000 on the credit side. So that's going to give us basically gain on sale. And we need to make up this difference by putting 10,000 on the credit side. So now we have 90,000 on the debit side, we've got 90,000 on the credit side. So notice the three scenarios of how to handle when you sell plant assets. Okay? Let's now change gears and switch over to exchanges of plant assets. So to help me do this, I'm going to use the same data that we had before. And this time, I'm going to create another little chart, and we'll call this one new. And we got the price, we have the trade-in value or trade-in amount that we get, and we have cash paid. So let's pretend that we upgraded. So think about when you trade in your car, you're hopefully getting a newer model, and the new one probably costs more than the old one, not every single time, but most of the time. So let's pretend that we're going to upgrade and this new model is going to cost us 100 grand. And what's going to be different in the three scenarios this time is the trade-in amount. Okay, so for the first scenario, let's say we go to trade in our old equipment and they give us 20,000 for it. So if they give us 20, we don't have a gain or a loss because our asset is worth 20. So whatever the trade-in amount is, you're going to compare it to the book value. That's kind of like how cash worked in the first scenario. We compared it to the book value. Now we're comparing the trade-in value to our book value. So if this new asset costs 100 and they're giving us 20 for our old equipment, we got to come up with 80. So this is our new chart. So the three scenarios that we're going to be involved with here is A, trade-in amount of 20,000, B, trade-in amount of, let's go 25,000, and then C, trade-in amount of, let's make it 17,000. So in the first scenario, break even. Second scenario, gain. Third scenario, loss. Okay? So let's see how the journal entries look in this situation. So let's go to repeating this data. So again, 80,000 and the accumulated depreciation 60,000. Okay, so that's set in stone. No matter what, that's set in stone. Let's change this to a different color. And we'll change this to a different color and change this to a different color. Alrighty, so let's do scenario A this time. So keep in mind that we're trading in our old stuff for new stuff. So we are going to debit equipment, and I'm going to write in parentheses the word new, just so we don't get confused. I have to get rid of my old stuff. So the old accumulated depreciation is going away. And the amount that I'm going to put in there is that 60,000. I'll leave that first debit for last. We're getting rid of our old equipment. And our old equipment is on the books at 80 grand. Okay. And if you recall, we have cash paid in this situation. So I have to credit cash. And the amount of cash is 80,000. Just a coincidence that they're both 80. So if I look at 80 and 80, that's 160 on the credit side. My debit side has to also equal 160, so the missing number is 100,000, which so happens to be the same number that's in the chart. If you notice, basically we got rid of the old equipment along with its contra, we added the new equipment, and we recorded the cash. Okay, so basically most of our numbers came from the chart. So now let's look at scenario B. Scenario B, we traded in this old equipment, but this time we got 25,000 for our old stuff. So let me recopy this. I'm going to bring this down here. And I'm going to change this number to 25,000. So that means if we're getting 25,000, we have a gain, and we only have to come up with 75,000. So this scenario, we have a gain of $5,000. How am I getting that gain? I'm taking the 25 that we're getting for it, and it's only worth 20. So 25 minus 20, that's how I have that gain. So scenario B, again, I'm getting new equipment. I'll leave the debit for last. We're getting rid of the old accumulated depreciation. And the old accumulated depreciation is 60,000 from our T account. We're getting rid of the old equipment. And the old equipment is on the books at 80,000. How much cash are we paying? We're paying $75,000. So now we have 155,000 basically on the credit side. We only have 60,000 on the debit side. Okay, so in order to get my debits to equal my credits, I got to figure out what's the difference. So 80 plus the 75 minus the 60, that's $95,000. So on the books, we're going to record the equipment at 95. So you might be thinking, hey, what happened to the gain? I thought we had a gain of 5. Well, if you remember, when we had no gain, the equipment went on the books at 100. But now because we had a gain, that gain gets deducted from the value of the new equipment. So going forward, we only get to write off 95. In other words, if you remember right from the beginning of this video, I had mentioned to you that gains are never recognized when you have exchanges of plant assets of like purpose. You only show the losses. So that's actually a good thing, because if you show a gain, you have to pay taxes on it. So we actually get a tax break by not having to show the gain. So in essence, basically what did I do? I just took the gain and I subtracted it from the price of the new machine. That's the easiest way. So 100 minus 5, that's how we got 95. Okay? Scenario 3. So in scenario number 3, we said the trade amount is going to be $17,000. So that means we got to come up with $83,000 in cash. That's the most cash we've had to come up with so far. So let's go ahead and do the journal entry. Now, in order to do the journal entry properly, we've got to know, is this 17, or excuse me, in this case, $3,000 loss, let's write that down. Is the $3,000 loss material or immaterial? Let's handle it both way. Okay, so we'll say assume loss is immaterial. We're not going to show the loss. So don't show the loss. And then the other scenarios will assume it is material. Okay, so if we can't show the loss, the journal entry is going to pretty much look like what we did over here. I'm just going to copy it and paste it. But the amounts are going to be a little different. So the cash we got to come up with now is $83,000. So that means the equipment now goes on the books at 103. So notice I didn't show the loss, but the $3,000 loss got added to the new equipment. So meaning that going forward, instead of getting to write off $100,000, I get to write off 103. So if I don't show the loss or I don't show the gain, the loss and the gain have to be absorbed into the new equipment that we're buying. If this loss was material, we show the loss, and the journal entry would look like this. So we're going to debit the new equipment, and it would be debited at $100,000. So we actually get to use the value of the equipment that we're acquiring. We will have loss on exchange, loss on trade-in, loss on exchange, something like that. And that would be for $3,000. So notice this time we're showing the loss. We got to get rid of the old stuff. So let's get rid of that old accumulated depreciation of 60,000. The old equipment, oops, I'm supposed to, yeah, sorry about that. So now let's get rid of the old equipment. And the old equipment is on the books at $80,000. And now I got a credit cash. And the cash is how much we paid, 83,000. So here are the two scenarios if you have a loss. The first one is you don't show the loss because the loss was immaterial. And in D, I said, what if the loss was material? And we actually get to show the loss. Okay, that's it, you guys. So I hope this was helpful, and you may want to review it more than once before you know, uh, think you may have it down pat. Maybe you got to get ready for a test or an assignment. I hope this helps. All right, we'll talk to you next time. Again, this is Professor Sam Lanzafame, and I hope you're enjoying these accounting videos. Take care. Bye-bye.